Good morning, everyone, and welcome to our webinar called Natural Gas Price Pathways. My name is Al Salazar, and I am head of oil and gas macro here at Enverus. I guess natural gas is such a fascinating subject, especially when you get out into the 2030 range. We just had a period of really high prices last year, and now clients and everyone in the market is wondering, where are we going to go from here? So how we think of it before we get into any slides is we like to divide the gas outlook into three distinct periods to 2030. The first period, which is basically the rest of 2023 and into 2024, is what we call supply purgatory. We've got plenty of supply, economic supply at that. And really, that's where our outlook is, that we're stuck in this, call it $3 to $3.50 winter price range and $2.50 to $2 summer price range. And it's really hard to break out of that. And I'll show you why. In the middle decade, which is our second price period, is 2025, 2026, and 2027, is the LNG, the LNG gates are opening. And what we mean by that is that North American gas should have access to international higher prices. And on top of that, giving some upside to prices, is that Enverus has the advantage, the competitive advantage, of having data on every single well in North America, which we conduct economic analysis on every single one. And we think that supply costs are going up. And then that gives us a bit of an uplift. And the last period in this three-period division is what we call judgment in 2030. That's 28, 29, and 30, where really the debate between renewables and gas-fired generation and whether all that LNG has a home is going to be settled. So going into our first slide here, click to the first slide. You could see this is our price outlook. So this is what I was just talking about. 2022, really unexpected. Henry Hub hit $9, NYMEX, and then looking at our price forecast, we're really not deviating that much from the strip. Certainly, the strip is showing us some upside in 25, 6, and 7. And again, that's driven from the LNG, and the upside due to supply cost increases. Where we slightly differ today is that $5 handle in 28, 29, and 30. And the conviction on that is about 50-50 at the moment. If you twist my arm, I'd say, hey, it's going higher because we have some reservations of whether or not, the gas-fired generation will be displaced by renewables. But we'll get that. We'll talk about that topic in a bit here. So first, let's talk about the next slide here. Let's talk about how price formation comes about. This slide we take straight from the EIA, and you can see that on the horizontal axis here, inventory versus the 5-year average. This is gas in place, gas in storage. And then this is the prompt NYMEX price. And it really is a bit of a shotgun blast. There isn't a relationship here that, good old regression modelers can figure out where gas prices are going by having an inventory guess. And this is where, not to make too much of a sales pitch here, but this is where the Enverus advantage comes, because for us, gas price formation is driven by the marginal cost. And certainly that's when the advantage of having break-evens for every well in North America, comes into play. So what does that mean in terms of, what happened this past summer and where we are today? I want to point everyone's attention to the chart on the left, which is the storage level, U.S. storage level. If you recall, in the summer, we were, the market was worried about hitting 4 TCF by the end of injection season because we had so much in storage in place. And what has happened is that we're on pace for probably 3.7 end of October level. And it's only 2 weeks away, but you can see that's not really that much above the 5-year average. So what happened? What caused that, that reconciliation and that avoidance of that enormous storage number at the end of the injection season? Well, the chart on the right is what you get when you strip out the weather from the weekly injections. Weather drives 95% of whether you build or draw from inventory. And it's showing me here in 2023 that in the summer that we were injecting, close to 2 BCF a day less than what the weather would indicate. That's a significant tightening. And that prevented that 4 TCF car crash from happening. So what were the components that led to that balance tightening? Well, first, certainly it was weather. The chart on the left shows you here, this is cumulative cooling degree days. If we had normal 30-year normal weather, we'd be on the 0 line. But you can see South Central, right around June, July, August, that Texas heat really came on strong. And the lower 48 at the end of the summer season ended up being close to 10% above normal. So you combine that with what was going on in the power generation sector. So how you read this is just looking at, this is absolute, gas-fired generation, coal, nuclear, wind, and hydro. I've adjusted it all for a constant heat rate, and just to give you an easier way to compare things. Certainly it says right now it's probably about 3.5 BCF a day year-on-year increase in gas-fired generation. Some of the EI numbers are a little bit lower, but that's probably a heat rate thing. But nonetheless, we had a really strong gas-fired number this year. Call it 3.5 year-on-year. Coal, it came in as expensive coal. Some of that is coal plant retirements. Some of that is certainly, favorable natural gas coal price spreads. But this also contributed to that tightening of that balance. Well, what about renewables? Renewables, you can see wind was a little bit lower, was a bit weak year-on-year, and so is hydro, but solar, certainly that offsets some of that renewable weakness. But overall, it really was a battle between gas and coal this year. Actually, it wasn't much of a battle. Gas took pretty much all most of the gains in the power generation sector, which helped, again, tighten that balance. Now, looking at that switching economics I was talking about, the chart on the left, and we're big at weather adjusting here, you can see this is basically the yellow line, or the orange line is the actual gas-fired generation over time. And if you just, put in the weather and whatever the difference is, you can see these pink lines are telling you that, wow, we really were consuming a lot more gas than what the weather was expecting. And again, that's because of the pricing spreads, that's because of retirements. And certainly this slope tells us that, about $1, if it's in fit by about $1 an MMBtu, you get about 900 million cubic feet a day of switching. And certainly that's not the perfect relationship, but it tells you that prices do come into this in some ways, historically at least. Now, what else was that? That covers the demand side. The supply side, we saw a reduction in Haynesville activity, right? And going forward, you can see this is showing you the horizontal rig count, the division between public and private, and certainly there's the Henry Hub price. We came off from a high of a combined 60 rigs in 22 and 23, and now we're in the mid-40s. Here on the right-hand side is the completions. Same story. Definitely a contraction in activity, and that helped, tighten up the market this past summer. And it certainly materialized in the production data. So on the left here, you see dry gas production. Certainly we've got data from Reuters, EIR, which is Enverus Intelligence Research, and the EIA, and we showing some strong growth. But if you look at the year-on-year numbers, started off strong in terms of production, but again, that reduction activity certainly started to weigh on supply as the summer progressed. So going back to our tightening of balances over the year, the market responded, and that's a key thing. So when people are, one of the most asked questions we get is, how do I get to $4, next summer? How do I get to $5? Is that even possible? I look at how quickly the market responded over the past spring and summer. Within 2 months, you already saw supply coming off, and you saw the power generation pick up year on year. So that's why in this 23-24 period, there's nothing structural that changes too much. That's why we're stuck in this tight trading range for prices. Now, it's early. People are wondering, what does the winter hold for storage? We've got a massive range here. Like I said, we're starting off the withdrawal season at 3.7, call it. If you had the 5-year average weather, you get 1.62 TCF is 5-year average, and this is your band, whether you get a warmer winter or if you get a colder winter. Certainly the NOAA forecasts are saying the probability is geared towards a warmer winter, so we may be coming in a little bit high on these numbers here. But then again, we expect that you get that same type of contraction on the producer side, that if prices get weak because of a warm winter, you're always going to be stuck in this range-bound pricing territory. So what about the medium term? Well, this is market consensus by now, and that is a lot of LNG. What I want to point everyone to is their attention right around the 2025 period. Look at that increase, 5 BCF a day, right? That's a significant step change, right? And that was, prior to that, 22, 23, 24, the LNG capacity, export capacity didn't really move much, but it really starts to come online in a big way in 2025. Mind you, there's some in 2024 also, but that to us is that uplift that we're talking about. Now, being on the road and talking to plenty of our clients, the question is that, is there a home for that gas? One of the things that we're concerned about is certainly folks will think, oh, that LNG is going to Asia, right? And if I go back before I get to that slide, if it's going to Asia, we decided to take a quick look at what's going on in China. And from the press releases, we can see that there's about 18 BCF a day of pipe coming in from Tajikistan, Russia, Kyrgyzstan, that is feeding China gas. And we don't have any visibility on this. This is just press releases. That to us is a bit of a yellow flag, that it feels like if North America has to compete with Russian gas, that's going to be something that tells us that, you know what, you just can't expect the home is destined and guaranteed for this, even though 80% of this is FID. So it's just something to keep in the back of your head. But that said, before we get into the dynamics of LNG, I want to get to here is basically, if we assume that all that LNG finds a home and that, gas-fired generation, we don't have any displacement for renewables, this is what the supply growth has to be. Now, that's a very important caveat, so I'll repeat that. If we assume that all the LNG finds a home, that's 30 BCF a day, and that power generation and renewable displacement is not an issue, and power generation is relatively flat, this is what we have. And the first thing that pops out in people's heads is, wow, that is a lot of gas that comes from the Haynesville. Now, in real markets don't work like that. I mean, certainly the price signal would come well before that, but this is just, in model land, is telling us we need almost 6 BCF by 2028. Why is that? Well, that's a combination of offsetting declines. That's a combination of having to fill in for the LNG uptake. That's a combination of also looking at, feeding that power demand that's required and keeping that flat. But again, that is, if all the demand components are relatively in check in terms of a bullish skew. Now, people will ask, well, why is it always coming from the Haynesville? Is there any potential for Appalachia? We have studied MVP. The region is notoriously constrained by pipe. MVP is certainly has one major project, but it feels like it's just moving the constraint further downstream and it's not really addressing the issue. But there isn't much potential there. Getting a new greenfield pipe that gets you somewhere to the Gulf or gives that incentive to increase Appalachia production, it looks to be somewhat contentious, to say the least. Now, back to that unreasonable Haynesville need, right? Again, this is model land. That's a lot of growth, right? And we've talked to midstream operators and say, well, we can't build a massive pipe unless it's $5 an MM. And that's another reason for why we're somewhat optimistic in 2029, 30 for higher prices, is because back to that story, if you believe the LNG is completely accounted for and that we don't have that displacement, Haynesville has to come to the rescue. It requires a new pipe. It's higher cost tier one inventory is beginning to run out at this point, that's that's a green light for $5. But before, I was alluding to some of the longer term risks. We were in Houston probably a couple of weeks ago, and certainly that's one of the folks were saying this is the most hated slide in Houston. I would have to agree. But when we looked at it, the EIA in their base case has a pretty significant decline by 2030. It looked like it was about 9 BCF a day in gas-fired generation, which is enormous. And doing a double check, we looked at the individual system operator forecasts and their outlooks, and it sums out to about 6 BCF. That's significant. That's nothing to stick at, especially with a 30 BCF market today. And taking it at face value, if you were to strip out, like I said, that 6 BCF to 9 BCF, we don't need Haynesville anymore. We don't need that pipe anymore. We don't need some of these marginal plays, and it really puts that $5 price at risk. On top of the LNG that we were talking about. Now, another thing also, I alluded to this a little bit earlier in that Chinese natural gas import capacity. Again, this causes us a bit of pause. Now, jumping around a lot here, you're looking at the Asian market, looking at Japanese power demand, it's declined for over the past decade. And their government has sights of basically trying to have 30% of its generation served by nuclear, which is a hit on LNG. South Korea, strong power demand growth, but they have stated they want 30% renewables by 2030. India, one of their offshore producers, wants to increase gas production by BCF a day. They're not really that big on gas-fired generation at the moment. There could be some growth on there, but again, it's not clear. Looking at Indonesia, I believe they want to double their gas production. Shell I think is leaving the country, so that could help the LNG story a bit, but there's a bit of contentious issues there too. And in Europe, if the LNG has to go to Europe, certainly that also has some challenges with it, because Europe has some of the most aggressive renewable targets by 2030 that are equally as stringent as Asia. So to put it all together, going back to our price outlook, and to summarize everything, if I was to take a look at this near-term price outlook, again, it's really hard to see an environment where we go above 4. Certainly, if you get really cold weather, you might get a spike, but we've shown that supply demand matches very quickly. 25, 6, and 7, I want to hammer that home. There should be some uplift. We have very detailed inventory analysis, break-even analysis that says there's some upward price pressure. And certainly the LNG, if it's spoken for, which 80% of it is, it tells you that you should get some international access to prices. 28, 29, 30, and naturally the farther you go out in the forecast, there's a lot more uncertainty. But what has us keep us up at night certainly is the gas-fired generation debate, and that gas-fired generation debate is global. Our energy transition team is working diligently trying to figure out, what the true answer to that question. For now, our base case is that we don't see that much displacement, which is constructive for gas prices, but certainly it could be quite a different story if any of those mandates are met. Now, we've been asked, okay, so what are the signposts we need to watch for in the coming, basically next year and coming year, to see which way we're going in terms of prices, and is there even a potential for a breakout? So if I was to go back to the end here, not to there, but to the end, the closest, the LNG build-out is so critical. We have LNG experts that are telling us that labor is becoming an issue that may push some of those projects a little bit back. That could cause, maybe a bit of a downward price pressure if producers are trying to time their production to match with that LNG uptake. That's the signpost to watch, is the labor and how quickly those projects come online. And the same thing with the ships. Watch the LNG tanker ships, and the construction and the ability to feed the need for tankers. So that's one thing to watch on there. The second thing is really how real is this pipe stack, and is there signs of construction in Power Siberia 2 or Line D? China has a very strong power demand trends. It seems like there could be I think they're consuming about 25 Bs of gas, and it could certainly double by 2030. But if you're serving a good chunk of that with pipe from Russia, that's something to watch, absolutely. And the last thing to watch is how does this power generation in the United States play out? Certainly, the IRA is geared up to facilitate the energy transition and the renewable build out, but that certainly, these things never happen in a straight line, and how that plays out probably in the next couple of years will certainly shape how prices and generally the outlook for gas shows up to the end of 2030. So that's all we had for today, really. I'd like to thank everybody for attending the webinar. If there are any questions, I would love to hear from you. It's been a phenomenal 2 years for natural gas, volatile nonetheless, and our story is just getting started in terms of how things unfold over to the rest of the decade here. But we are going to open it up for questions here, and I'm just going to look and see.
Yeah, it looks like we have quite
there.
a few questions coming in. Thank you very much, Al, for that presentation, and thank you everyone for these questions. Looks great. We'll try and get through as many as we can. Looks like the first one here we got was, what is the biggest risk to your near-term price forecast?
Biggest risk, yes. So I know there's so many producers wanting the $4. Saying it just, we were at $9 just last year. The biggest risk, aside from weather, and you kind of look to European LNG, and you look at European stock levels, and they're almost full, so there doesn't seem to be much upside there. It feels like the biggest risk is producer behavior, but certainly looking at how the past summer has played out, there's reactions there that tell that it's all rational. So I really can't see a sustainable way out of this range that we were talking about. I know that's probably a bit of a cop-out, that I can't see many massive risks, but that's just how it is with plenty of inventory in the near term here and nowhere to go. It's hard to envision a sustained breakout. I hope that helps.
Great, thank you. Looks like the next question we have here is focused around the Northeast, so wondering if it's possible to get any new greenfield pipe in Appalachia or from Appalachia.
Yes, we have a Northeast expert here, and him and I agree that getting a greenfield pipe is going to be pretty tough, especially with how MVP played out, and certainly given the direction that some of these forecasts are heading in terms of that energy transition, this gas-fired generation being displaced by renewables, it's going to be very hard to justify until that plays out. So I would put the probability of a new pipe as being pretty low.
Awesome. I think maybe for our final question here, what do you think are the biggest global demand risks? You talked a little bit about the China transitioning. Could you elaborate on that?
Yes, I mean, I see on the screen here we had a question about Chinese domestic production. Certainly that's bearish LNG imports. Looking at disbalances, China has had a strong inclination to be energy independent. You look at the aggressive targets to electric vehicle adoption. That's all just to get away from oil dependency, their SPR build, all of that. So I suspect that the Chinese will do everything in their power to increase domestic production to further, reduce their dependency on LNG imports, especially from the U.S., given the way the geopolitical situation is working out. That said, there's still potential. I mean, the reason why I say is mandates are pretty tough to. History shows they're pretty tough to attain in a linear fashion, and in the event of not meeting those mandates, certainly a 30% renewable target or what have you, gas is the most reasonable, viable option. So I wouldn't discount it yet. It's certainly not a straight line.
Yeah, I think that does a good job answering. Another few questions here around, what's driving power demand losses, and the global demand picture, and really just being those renewables. Is that the main contributor?
Yes. Well, I mean, when the ISO questions is basically you take their modeling, they have their own assumptions about electric vehicle adoption. They have their assumptions about how much renewables they want in certain mixes, and that's basically what I believe is spit out as base cases for their targets for 2030. But like I said, we were just having a discussion about electric vehicles in the United States, and certainly the sales uptick has disappointed over the past couple of months. But there's still targets to get to that, roughly 50% of sales target by 2030. That's why it's not completely a foregone conclusion that natural gas and LNG is not needed because of that uncertainty in the back end. So I wouldn't pay too much attention to the EIA 9 BCF a day number, and the ISO number at 6 seems pretty high as well, given the way these things play out. But it feels like saying that it has zero effect would be also a bit of an outlier. So it's got to be something. Okay, I think that's it. So if there are any questions, please feel free to reach out. This is a pleasure to do, and we hope to see you again in the future.